3, 2, 1. A very good evening, ladies and gentlemen. I, Karan Mutneja, partner at Perspective Tax Consultant Dubai, welcome you to today's session on a very interesting topic: 7 ways to structure your wealth. Chris Rock once said, wealth is not about having a lot of money. It is about a lot of options. So in our today's session, we are going to talk about various investment options and the risk question involved. We have with us Jaisar and Mr. Dipin Kwatra. So now with great pride, I welcome our first panelist, CA Jaikumar Tejwani, a name who needs no introduction. A practicing chartered accountant for over 25 years, Jaisar is a regular speaker on international taxation, direct tax, NRI, and FEMA matters. Today, Jaisar will elucidate us on the new age investment options like technology, education, intangibles, angels, and traditional investment options like FDRs, PO deposits, PPF, gold bonds, and also touch base direct equity and equity mutual fund options. Welcome, Jaisar.
Thank you, Karan. Thank you for this wonderful introduction. I would request you to please allow me to share the screen.
Yes, sir. You can share your screen.
Yeah. Thank you. So good evening, all my dear friends who are participating in today's webinar. And this is a very interesting webinar, as Karan mentioned, 7 ways to structure your wealth. What every investor, be it a new investor or a person who is already investing, what we need to really know about maximizing our wealth. We are going to talk about 3 things today. Number 1, how to really be on the top of wealth creation, how to identify our risk quotient, and what are the investment options which are available with us. And hi, I am CA Jaikumar Tejwani, thanking once again Karan for your kind words. And so let's start with the session on the wealth creation. As you know, it's a very nice saying that a doctor cares about your health. Similarly, a financial expert cares about your wealth. So why do we leave the chances to manage our own finances when the experts are available to guide? The 3 very important steps to get into the wealth creation is, number 1, to save smartly. Let's learn to manage our expenses in a way that we can save the amount that we want to save every month. Fix a goal, and then whatever your savings are, turn them into investment through the systematic investment plans. We can channelize our savings into investments by defining a goal. What is our goal of investment? Are we trying to build corpus for buying a house, for our travels, or getting into some luxury, or the retirement plans, so that our age, when we are not earning, we have enough? So define your goals clearly and accordingly identify the investment along with the tenure. So if you're saving for your own education, your kids' education, identify the tenure and select the right mix of the mutual fund or the equity or any other investment, considering your goals and tenure. And third, very important step, that increase your investment periodically. And like it is said, that testimonials are short quotes from people who love your brand. It's a great way to convince customers to try your services, meaning thereby that we need to be on the increase mode every now and then. And if we are blessed with some bonus incomes, invest in lump sum wherever possible. And always take the help of a financial expert on all these matters. What is wealth generation? Just theoretically, what is wealth generation? So, wealth refers to the processes, the plans, the savings, and the investment that we make to ensure that we accumulate enough capital to realize our dreams, to provide for our loved ones, and lead a comfortable life post our the period when we are not earning or earning less. And for myself, I learned this lesson while I was in Dubai very recently. I had a very interaction with somebody well known in the wealth creation. He actually made me understand what wealth creation is. He says we manage wealth for 120 years trust, and we just don't give income. We manage the capital which grows automatically and systematically. Though income generation is very important, but income generation is something which generates an income, you get it, you spend it, that's it. Wealth is which accumulates, which compounds on its own. Maybe a sum of 10 lakhs put at the age of 30 years could become 10 crores when you are in the age group of 60. Our very dear friend Dipin is going to talk about it. So, income is when you get your salaries, your savings interest, your dividends. You get it, you spend it, that's it. Whereas wealth creation is when you reinvest. You are in the mode of recreating your wealth. So, this is what, and remember, my friends, remember the rule of 50-30-20. So, we are not saying don't spend half of your money in your needs, wants, travel, luxury. Because if you don't spend, how is our economy going to grow? Worldwide, it is the consumption rule 80-20, that you spend 80, but still, we are saying spend at least 50% so that our economy equally grows. And it is with our own expenditure that we contribute to the economic development. 30% should go to your education, health, charity, insurances, intangibles. Every time you add education to your skills, believe me, your income increases on a minimum side by 10%. And then you contribute nearly 80% to the GDP of the country. Health. Health is the most important asset. If you create wealth but you do not have health, challenges. Also contribute something to the charity. Giving, always you receive back multiple times. Another very important 30% is insurances. Never forget, as step one, as soon as you start earning, to take a term insurance. It is must, my friends, must to have a term insurance as the first financial tool. Second, take a good mediclaim policy. Mediclaim policy, you may not realize the importance, if you are maybe in the age group of 30-40. Even at the age of 40, 10 years back, I was having a 5 lakhs mediclaim. Somebody advised, I followed the advice, took a mediclaim of 20 lakhs. Within 5 months, I was in need of a very, very significant surgery, which costed me 15 lakhs. And this mediclaim policy helped meet me all my expenses. So 30% into all these things. And then the remaining 20%, they should go to your savings and investment. And as I mentioned earlier, this 20% could always fluctuate. Try to increase it as per the needs and as per your savings. Again, another theory which is very important is, before we get into the wealth creation, know your risk quotient, your RQ. we have to be very, very clear. Are we risk averse or risk friendly or risk neutral or somewhere in between three of these? Some of the important tips which help us in identifying. We consider 100 minus age for allocating to the equity or the so-called risk investments. So somebody say in the age group of 30, 100 minus 30. So 70 is what you could consider your savings into the equity or equity mutual funds or the so-called uh, investments which may yield higher returns in a longer run. RQ2, age. Generally speaking, younger people can and they should take greater risks. As you grow older, you should be enjoying the benefit. And now, recently, I have seen people in the age group of 22, 23 after completing their education. They're actually landing into good jobs. They have enough money, but not sure how to invest. So, do consider these RQ points. And once you are married, you have your family, and even this is applicable for all young children, old parents, you may like to take fewer risks. So, summary of this is that up to the age of 35 years, your RQ could be 70s to 30, 70 in the high generating risk investments. 35 to 40, RQ could be 60 to 40, 45 to 55, 50-50, and as soon as you cross 55, considering your status, your RQ could become 30-70. Of course, these are all theoretical numbers. They will depend on the kind of your incomes, your status, your understanding, and also your responsibilities. So now we come on to the main topic of the day, the 7 ways to structure your wealth. Number 1 is the new age investments. What are those options where we can actually think through to invest? Second way, to be a angel investor, angel investment. Third, a very recently opened arena by Government of India, investment outside India, sitting in India, even applicable to the resident Indians. Fourth, the direct equity investment through direct equity, equity mutual funds, index funds, etc., which Dipin Kwatra is going to cover. Next one is the real estate and the gold investment, a must for everyone, but with lot of ifs and buts. Retirement and pension fund investments, very, very important for all of us, whatever age group we are in, to consider it right away. And finally, the very low risk deposits and savings. So let's talk about all these in brief details. What are the new age investments? The areas which still needs a lot of exploration. Number 1 is to start to invest in startups. India is the topmost startup growing economy, where 5 years back the failure rate was 95%, but now 10% startups are becoming very, very successful. Another 10% doing reasonably good, but recovering in next 5 years. Next 10% are decently in the market, taking their time to grow. 70%, yes, still not very successful. But this is a great, great area to invest. Second, specifically in India again, leasing of assets. I was reading a news article day before that bikes are required in the market because all these online chains, they need people to get them bikes so that the products could be delivered. And believe me, again, this is a new and a very upcoming area. Third, inventory financing. Banks generally give you some kind of a cash credit limit or inventory, but people are looking for investors who could finance their inventory. At times, the products are not available while they are in demand because the people who are procuring them do not have money. So inventory financing is something which is upcoming and growing. And the returns which I have mentioned in this, they are on the lower side, but still the average expected returns on the new age investments could be anywhere in the range of 15 to 20%. And we can explore these some of these branded platforms like Grip, Our Crowd, Coffee Mug to explore and understand about new age investments. Second one is the angel investment. As soon as you have surplus fund exceeding 50 lakhs, surplus fund after all your investments, and you have at least 5 years in hand, and you are a credential investor, register yourself with Let's Venture, Coffee Mug, and lot many platforms which are providing angel investment to startups. And believe me, as I have done myself, a lot of people come to you, give their presentations, and you really take out and find out the genuinity in those presentations. The returns could be very high. In fact, recently I invested through as an angel investor. The returns were as high as 22%. Of course, in the second year, first year it was not there. But now I expect to get reasonably good returns. So another new age investment. Third is investment outside India. It was always there, but recently government has liberalized the methodology and given more wings to the Indian investors. So there are a number of options. I have listed 4. One of them is funds of funds. Funds of fund, not funds. Funds of fund. In short, we call it FOF. So these are mutual funds which collect money from you in India and invest outside India. No LRS applicable, nothing, no government regulation. It is simply an Indian investment, and the funds are investing outside India. And then there are index funds. Like one very popular is the Motilal Oswal 500 C&A index fund, giving a reasonably good return. And you could always have direct equity investment. Particularly USA has allowed direct equity investment by resident Indians. Another very exciting, in fact, which we explored very recently was the foreign property investment. UK, Singapore, GCC countries, including UAE, they are allowing the people outside their own jurisdiction to buy properties. Karan would validate that how fruitful and the kind of rewards that we have got is just amazing. So we can always consider investment in properties outside India. Of course, investment outside means when you have sizably good funds in your hand and funds which can otherwise take care of you in India. And expected returns on the minimum side could be between 12 to 17%. Various platforms available to impart us more knowledge, including Grow, VC Circle, Motilal Oswal, which really guide us on all these options. Equity investment, which our learned friend Dipin will cover later. Expected returns could be on the minimum side between 12 to 20%, though it falls in very high risk. But then, if the risk is properly understood and managed, equity could really give us some wonderful returns. Real estate and gold. Yes, we should have at least one residential property for us to live comfortably. But residential property as an investment is not something which I recommend. Not very good. Not only in India, even outside India. So we can concentrate more on investment in commercial properties. Commercial properties, particularly in places like India or in places like Dubai, is something amazing. A lot of societies coming up in and around NCR with multiple society flats having some market area within the society. Believe me, a shop or a kind of a commercial space could really help us earn much more than what a residential property could return. One of the very recent examples, one of my friend bought 4 shops in one of the sectors in Noida, where all the flats were sold, and all the 4 shops he's running the grocery and the women related items, and he is earning a great amount of money. He's able to employ a lot of people to support him. And another example, one of our salon in our block, he gave his property. He has 2 adjacent shops, gave it to the liquor companies, and he's earning a rental of 6 lakhs. And he said, Bhaiya, I could never imagine earning, so much amount out of my property. And I have spent 1.5 lakhs to buy a 300 square yards of area for my salon now. So you never know. Commercial properties is something. Second one is the leased assets. Again, a concept, though in India, but very, very popular and coming up more in maturity in India. So like these big hotels, 5-star hotels, they give you an option to buy certain area, maybe in 1,000 square feet, 500 square feet, for a sum of money, and they guarantee you the returns, which could be depending on the area, a particular set of income. You can always sell that asset. Of course, you can never own or use that asset for yourself. It could be a big commercial office or a big 5-star hotel. And this concept is very, very popular in the areas like UK, in countries like Dubai, where you could really, really be benefited out of the returns. Gold and metals. India, we are very, very inclined to having gold. But instead of the gold in hard, the paper gold in the form of ETF could be a great option. Plus, the sovereign 2.5% sovereign gold bonds, which not only guarantee you the capital appreciation as the gold increases, but also a minimum return of 2.5% is given to us on investment. And again, this is a good way to hold gold. No returns, nothing. It could just depend on the kind of areas we have. And then sixth, and one of the very, very important, is the retirement and pension fund investment. There are a number of such schemes, but I have listed 2, which are very, very secure, guaranteed by the government of India. The Senior Citizen Savings Schemes and PM Senior Citizen Scheme. Both the PMVVY is more an insurance scheme, and the Senior Citizen Savings Scheme is more about the bonds. The expected minimum returns guaranteed are around 7.5%. And very important for all senior citizens in the age bracket of 60 and above to definitely consider investment in these. Investment advisors, banks, and direct investment are the options through which we can explore these. And finally, and one of the very, very important thing is deposits and savings. Our 6 months equivalent amount of our earnings per month. So if we are earning, say, 1 lakh of rupees, 6 lakhs, if you are earning whatever percentage into 6, should definitely be kept in deposits and savings. Some savings account in some of the tier 2 banks are offering the savings rate interest as high as 6%. Bank FDRs, though returns are very low, between maybe 3% to 5.5%, but maybe some amounts could be kept to meet any kind of emergencies. PPF, one of the best options. If you have not opened your PPF account, open it right away. It is tax-free and gives you a reasonably good return of around 6.8%, which are tax-free. Consider opening the National Pension Scheme, which is currently giving a return of nearly 7%. Various government bonds keep coming, like currently it is Government of India 7.15% bonds, which are there in the market with the tenure of between 5 to 10 years. Definitely we should put in some amount there. Of course, it's not that flexible, but still good returns. Debt mutual funds, very liquid, and they generally offer returns slightly higher than the fixed deposits. So this was all from my side, and I hope Dipin is going to talk more on the equities, and it will really help us to understand more about wealth creation and take it forward. Thank you very much, and over to you, Karan.
Thank you so much, Jay sir, for such informative presentation. And of course, sharing with us some of the very practical examples from life that will definitely help our participants. So now taking it forward, I would like to welcome my friend, Mr. Dipin Kwatra. Dipin is the founder and director of New Vertical Vera Private Limited, a boutique investment firm managing an AUM of rupees 300 plus CR. He specializes in pre-IPO investments into Indian equities. Based on one's risk tolerance and risk return expectations, Dipin helps to create wealth and generate an alpha over the benchmark indices. So let's listen to Dipin on how it works. Over to you, Dipin.
Thank you very much, Karan and Jaisar, for giving me such a wonderful opportunity to share my views on different ways to create wealth in the long term. I will just share my screen. Just. Yeah. So, Jason highlighted a very important aspect about RQ, which was the risk quotient. So, I have learned a lot about risk. I have learned a lot about to mitigate risk during my 15-year journey of wealth creation through financial markets. So, I firmly believe that there is no such thing as zero risk. There is an opportunity cost for every choice that we make, whether in life or with our hard-earned money. You have to take risk. We will only understand the miracle of life fully when we allow the unexpected to happen. So I have been a professional in financial markets and I adore my idol, Sir Warren Buffett, who says, the more you know, the less is the risk. In financial markets too, we can mitigate risk by sound knowledge, awareness, experience, and reading. In life, this is a small matrix, which is a risk reward matrix for life, which says that any task which is easy to do would reward less. Any task which is difficult in nature would reward high. So in life also it is true that taking risk rewards us in a very handsome manner. Now when it comes to investments, every investment you make requires you to balance between 4 different factors. That is risk, return, liquidity, and time horizon. In investments or in wealth creation, risk can be classified in below 2 forms. One is the capital risk, other is the return risk. In short term, there can be periods of high volatility because of any unforeseen events like we had one in 2019 or 20, which was the COVID-19. So what does happen when this kind of an unforeseen events happen in any part of the world? There is a capital erosion, there is panic, there is fear. I will share my own example. It was in the year 2020 March, where I did some lump sum investment into equities. I precisely remember the date. It was 13th of March, I guess. 23rd, the lockdown happened. My capital investment saw an erosion of 50 odd percent in a matter of 2 weeks. But since I knew what I was investing in, I was aware about the risk I was taking. I had a decent time horizon in mind. The same investment which show me a capital erosion of 50% delivered an ROI of 70 odd percent till last month. So this is a very, very true nature of the capital risk which is involved there in any equity-based investments. If you are aware about your time horizon, your liquidity, you can mitigate that risk by staying put. Other form of risk is the return risk. There can be prolonged periods of an asset class underperformance, during which an asset class may not even fetch you the return which is there in the fixed deposits or bank accounts. I think the real estate is one of the finest example. When I say real estate, I'm talking about residential real estate. People have bought residential properties across the world, specifically in Delhi NCR, thinking they would deliver them an ROI of 8 to 10% annualized. But real estate is, in its nature, never delivers an annualized ROI. You have to stay put for 5 years where nothing happens. Then comes 1 year of infrastructure reforms, of connectivity of roads, of airport announcements. That 1 year delivers the exact amount of 50 to 60% returns, covering all those 5 years. There's also a famous saying about that. There are decades when nothing happens, and there are decades when everything happens. That is where your investment may not give you a good ROI for 5 years and may give you a ROI of 100% in 1 year. This happened with one sector in last year, which was the pharmaceuticals. The pharmaceuticals, thematic mutual funds, and people investing in pharmaceutical stocks made single-digit returns in 3 years. That was between year 2017 to 19. And here comes what? The pandemic. The world was suffering. Only one sector was laughing, which was pharmaceuticals. Demand superseded supply. Every damn pharmaceutical company or every pharmaceutical fund across the world delivered an ROI of 80 to 100%. But that was after a prolonged 3 years of underperformance. So you must need to understand these kind of two risk involved in any kind of capital investment you make into equity or equity-related instruments. So to help you create wealth through equities or any financial assets or any real estate asset or any asset that you invest your hard-earned money in, apart from keeping the same in banks, I have designed this risk-reward wealth matrix for long-term wealth creation based on 4 different factors, which I just stated are risk, return, liquidity, and time. The horizontal axis in this matrix tells us about the type of investor you are, ranging from conservative to moderate to aggressive or to very aggressive. The vertical axis talks about the parameters which should be taken into account while taking any investment decision, be it any asset class. The decisions are too much personalized depending upon what kind of age group you come from, what is your risk quotient, as Jason explained. The liquidity, very important. We understate this important parameter because this requires a lot of attention, wherein you need to analyze for what period you may not be needing this sum. For example, if you have earned a bonus, you may not need to spend it on any lifestyle expense for next 5 years. You know that you do not need this liquidity in next 5 years. So you can invest this for a longer period of time. Time horizon, return. So we do carried away by high returns, but we need to understand that high returns come with the degree of higher risk. So higher the risk we are willing to take, higher returns we will get. People want higher returns with lowest risk, which is an impossible task to get into in any kind of investment across the world. Post we have done this analysis of the 4 parameters of investment, which is the risk, liquidity, time, and return. We need to understand what are the kind of asset classes available to us for investments. So practically the asset classes which are available to invest are predominantly in 4 forms: fixed income, real estate, commodities, equities, and currencies. I will speak more on equities and equity-related instruments available for us to invest in India and abroad. So when we talk about equities, so equities or equity-related instruments or investments can be classified into 4 forms. One is a mutual fund, wherein a fund manager manages the money collected by different people from different walks of life. You and me can even deposit rupees 500. An HNI client can deposit 1 crore. An institution or trust can deposit 10 crores in the same fund. He collectively pools the money and manages the equities or stocks on behalf of us. Because so much or so many people are involved in this, the risk is pretty low or moderate as compared to direct equities. Followed by ETFs, which are called exchange traded funds. I often come across a lot of questions like when the market corrects. Today is the best day to keep this presentation because we have seen the highest single day fall in the indices today itself, which is close to around 3%, 500 points in Nifty and 1800 points in Sensex. I've got so many calls since morning. Which stock to buy, what to buy. The easiest answer for this confusion is buy the entire market itself. How do we buy the market? How do we buy the entire market itself? Through an ETF, which is called exchange traded funds. This instrument is widely tradable on any stock exchange in India and abroad. If I talk about American markets, which we often refer to because they are more mature and more older than us, more than 40% of the investments in US markets is done through ETFs. This is not new in India, but people are not having any good awareness about this instrument. So if they have more awareness about this instrument, they might not get into the confusion of which stock to buy, which portfolio to create, and buy the entire market itself. Followed by stocks. Yes, stocks are very risky because there are about 7,500 companies listed in Indian Stock Exchange. It is a very difficult task, what to buy, what not to buy, which to buy, what not to buy. Followed by private equities and PMS. Mutual funds is by far is the most safest category for any amateur or retail investor to participate in equity as an asset class for wealth creation, which can be further subdivided into three parts. There are like hybrid funds, which is a mix of debt and equity, wherein some part of money is invested into stocks or equities, and close to 30-35% is invested into debt or fixed income instruments. So the risk is mitigated because of the combination of debt and equity. That is why I have mentioned the risk in this category from low to moderate. So it is best suited for a person who is looking for an alternative to his FDRs and bank deposits, but he is not willing to take higher risk in the equities. So this is something which is positioned between your fixed income assets and pure equities, followed by index funds. Index funds and ETFs are more or less same in nature. One is wherein ETFs, you take exposure through stocks. Index funds, you take exposure through mutual funds and buy the entire market itself. Followed by pure equity funds, which can be further classified into large, mid, or small caps. So this is something which can deliver you a return of as low as 12%, as the history says that we have been able to deliver a CAGR of 12% in last 25 odd years, as far as Indian market is concerned. Now, depending upon your age, your time horizon, and your liquidity, if you are willing to take higher risk, you can go towards mid-cap and emerging company mutual funds, wherein the risk is higher, but return is also higher. There have been instances wherein mutual funds like mid-caps or small-cap have delivered a CAGR of even about 22 odd percent. So all the figures that are mentioned in this metrics in the return tablet, in the return tab, are more on the conservative side. And some of these instruments have delivered far better returns than I have posted here. Coming on to next category of higher risk is stocks. See, so stocks is something which requires a lot of awareness, a lot of knowledge about the industries you are going to put money into before even the companies. So we follow a top to bottom line approach in the analysis we do while investing or creating a portfolio. First is that you need to be very, very confident about the country you are earning in, that is India. So invest in India. Modi ji, politicians, economists have been talking about India becoming a $5 trillion economy by 2024 or 25. What if even we are not able to achieve that target by 24? What if we achieve that target by 30? The bottom line is, if I take two examples of US and Japan and China, rather three, there was a time when their economy moved from 1 trillion to 2 trillion, then 2 to 3. So what happens when the size of the GDP doubles for a country? The statistics says that when a country moves from a GDP of 1 to 2 or 2 to 4 or 4 to 8, the stock market actually gives a return of close to 4 times. It has happened in our market as well. It has happened in China, Japan, and US as well. So if we move from a 2.5 or $3 trillion economy to 5 or 6, there is a fair chance of stock market moving from 60 odd thousand levels to 2 lakh or 2.5 lakh levels, or Nifty moving from 18,000 to around 70 odd thousand. And this is possible. Statistics says so, history says so. So if you are planning your investment in equities, keep an horizon of at least 10 years. You would be surprised the kind of returns it would deliver. Yes, risk has to be mitigated. So we need a balanced mix of mutual funds, ETFs, stocks, private equities, and PMS, depending upon what kind of risk you are willing to take and what is the time that you are willing to give your investments. The earlier you begin, the better it is because you have time by your side. Jay sir just mentioned about today's youth starting to work professionally at the age of 22 and getting handsome salary. So they have a good amount of money at their disposal to start invest now because they have 20 years at their side for the money to compound and deliver superb returns from this asset class. So whenever you are planning to invest in equities, first and foremost is to analyze your position in terms of these four parameters: risk, return, time, and liquidity. Then analyze what is the amount of money that comes under the high risk category and the low risk category so that they can deliver the far superior returns than you can even imagine putting money into conventional deposits. So how and when to invest in equities? Again, it depends upon your financial or investment goal and the time horizon. So the best time of investing in equity is now. After 2 years, it will also be now because if you are clear about your investment goals and time horizon, every time is the best time. You cannot time the market. You are investing in the long term. So I will help you to know more about equities and try to mitigate your risk. Because when you know more about equities, you know more about basic sectors, and you know about the process. How do you invest? You mitigate the risk. So this process I call as investing in what you consume. So in this picture, I have highlighted around 7 products, which comes from 7 companies. I think most of our Indian households and most of us have been using or have used these products even once in our life. Or a lot of these products are actually coming in our groceries, I think monthly or quarterly. There was a very famous legendary investor called Peter Lynch. He used to say that the greatest stock research tools are not balance sheets, not P&L, but these are your eyes, ears, and common sense. Why? Because most of the stock market is in the business of serving you. When I say you, I mean the individual consumer. If something attracts you as a consumer, it should also attract you as an investor or as an investment. So it is like 30, 40 years before, if you see a Bata showroom in your neighborhood, you see, oh, wow, Bata shoes are amazing. It attracts you as a consumer. You go to Lucknow, you go to Jaipur, you find another Bata store. So what do you see? A lot of people like you are liking Bata stores. A lot of people you are liking Maruti. A lot of people like you are liking Starbucks. Starbucks has redefined how we drink coffee. So we need to understand behind every product or service you have been using or you will continue to use in your family, there is a company behind that product. For every stock, for every equity, there is a business. You need to understand whatever money you are earning, whatever money you are spending. Jason mentioned about a 50-30-20 rule. 50% of what we earn goes towards spending, travel, leisure, groceries, lifestyle. You are spending this money, but you need to analyze or inquire or know, I would say. आपका 1 रुपया, आपका 10 रुपया किसके जेब में जा रहा है? Once you started analyzing these things, you will get knowledge, you will get awareness. Okay, this company is making such huge money with my spending. Why shouldn't I become a partner of this company and invest in this company? This is how you make money through equities. It is a very, very simple. It is not a mix of accounts. It does not need a lot of financial analysis. It needs basic common sense. So these 7 products are from 7 different companies. First one is Lakme Cosmetics from HUL. Next one is Parachute Oil from Marico. Other is Maggi Noodles. I don't think I need to tell who makes Maggi and who sells Maggi, which is Nestle. Ashirwad Atta from ITC. Breads from Britannia. We have been all grown up eating these breads in the last 20-30 years. Chyawanprash from Dabur and Tata Tea from Tata Tea. Yeah. So I have highlighted few more examples wherein the companies that we are talking about producing different products and services, what kind of returns these companies have delivered if you have added them in your investment portfolio for a period of 10 years. So these are 5-6 companies which have practically doubled your money, or doubled your investment in every 4 or 5 years at a CAGR of around 15%. Some of them have delivered a CAGR of beyond 20% as well. The time frame I have taken is 10 years. And I think most of the products are you know, or you have used even once or twice or multiple times in your life. First is Pidilite, the company behind Fevicol, M-Seal, and Dr. Fixit. At 27% CAGR, 1 lakh invested in this company would have become 11 lakhs now, 10 times or 11 times in 10 years. I was talking about a CAGR of 12%, 15%, 20% on the higher side. This one company, which still not has a very good competitor in this segment, is still delivering a CAGR of 20%, and that is for last 10 years, doubling money every 3 years. Next, SDFC. We are talking about real estate. We're in a housing boom. Every application goes first towards the SDFC Limited company to get a loan sanction for a housing project. If they reject, then it goes to other NBFCs. This is the largest NBFC in the country, managing 5.5 lakh crores. 5.5 lakh crores of loans. Growing your money at a CAGR of 13% year on year, doubling money every 5 years. I often tell people, if you are taking a loan of 80 lakhs against a property of 1 crores, take a loan of 60 lakhs and invest 20 lakh rupees in SDFC. You will be able to foreclose your loan in 10 years instead of 20 years. And that actually works, guys. Try this out. Tata Tea, the company behind your tea, the company behind your salt, the company behind your coffee. Tata Tea, Tata company, Tata Consumer manages the master franchise of Starbucks in India. They turned profitable in the year 2019. Till then, they were making losses. So every Starbucks outlet they are going to open now in anywhere, any part of India would be a profit center from a cost center. Who doesn't like to drink? You pay 400 rupees for a coffee in Starbucks against a 200 rupees coffee in Cafe Coffee Day. Against a 20 rupees coffee that you can make at your home. You spend in this lifestyle. Spend in this company, add this in your portfolio. Growing at a CAGR of 17%, doubling money every 4 years. Maruti. Every second car which is being sold in India is a Maruti till now. 53% market share, growing at a CAGR of 21%. These companies needs no introduction. These companies, you need to even penetrate deep into and understand their financial nature. Just believe they would be continue to deliver the fabulous products and there would be demand for these product and services. This one is my favorite because this company is into existence for the last 100 years, serving every 9 out of 10 Indian, approximately 130 crores out of 140 crores, has 60 products. Every 9 out of 10 Indian households uses their one or other product, from cosmetics. हम शॉप पे जाते हैं, हम ये नहीं कहते कि washing powder दे दो. We go and ask for Surf Excel. Each of its product have become a brand in itself, delivering a CAGR of 22% friends, 22% against a 12.9% CAGR of the BSE FMCG index. This is one company which is giving you double the returns of the sector. So the FMCG sector is growing at 13%. This company is growing at 22%, doubling your money every 4 years. The largest FMCG company in India. Lockdown आए, कुछ भी आए, we will not refrain from consuming. In fact, when things like this happen, the consumption increases. This company made a 52-week high of 2,400 in April 2020 when market eroded by 50%. That is the power of consumption, never going to stop. Even if our income would double, we will still be consuming the same amount of stuff we were consuming. Or even if our income would halve, we will still be consuming the same amount of stuff we are consuming. We will not having double the food. So consumption is here to stay. So does the consumption companies. I just wanted to share 2 basic rules for financial planning, you can say, or for your personal financial stuff, which we have learned in school also. This is nothing, though I have called it a wealth creation formula, but this is nothing less than the compound interest formula that we studied in our 9th standard, wherein most of us people are focusing on the R part, the return part, but ignoring the T part. T is basically the time that you give your investments to grow. So if you give them 20 years, you have the potential for your 100 to grow into 8 at a compounding of just 12%. Imagine at a compounding of 12%, your 100 can grow to rupees 800, provided you have 20 years to invest. You need to start investing early. This is what this formula says. So when you are investing in any asset class or any financial asset, you must know this rule of 72, which is nothing but just you need to divide 72 by your rate of return to get the time in which your money would double. So this is a small table you can just refer to. At 3%, it will take 24 years. At 12, it will take 6 years. At 18, 4. And at 20, it will take 3.5 years. So I mentioned that how much years it would take for at what percentage for money would become 8 times. This is small tweak that you can do in your lifestyle expenses to take out money to invest and create wealth. Because I often come across this silly answers that you are asking us to invest, but we do not have money. So I give them the solution. You just need to tweak your lifestyle expenses. Post that you will have enough money to spend, to compound, and to create wealth. Choose rightly and wisely, because what you prioritize and invest in today will determine your tomorrow. So thank you so much for the patience, audience, and listening me out and helping me to tell you more about risk and mitigate your risk to create wealth in the long term.
Thank you so much, Dipin, for such a wonderful presentation and providing us great industry insights as well. So now we have some questions from our participants. I would like to take up some questions, sir. So the first question is, how is investment in cryptocurrency? What are the risks and returns if we invest into cryptocurrency? So I would request who will be taking up this question.
Jay sir will take up this question. He's more experienced in cryptos.
No, cryptos is very exciting, and it's a great opportunity actually. But currently, from Indian perspective, because the laws are not very clear, the bill which is already pending and with lot of ifs and buts. So as far as Indian market is concerned, not really that we are recommending exposure in the cryptos. In fact, even the tier 1 bankers, they have stopped transacting in cryptos. So for India, let's wait and watch. But for sure, this is another new age future investment. But Karan, from international perspective, like UAE, as you also mentioned the other day, that already a exchange is set up just to deal with cryptocurrencies, and UAE is coming out with its own currency, which is a cryptocurrency. So internationally, yes, it is exciting, very exciting opportunity to at least take some exposure in cryptocurrencies. Yeah.
Thank you, sir. Second question is, returns in equities always resulted in huge losses for me. I have taken services of all big investment advisors, but with negative returns. What do you suggest? I have additional amount of rupees 50 lakhs. I think this goes to Dipin ji. If you can take
I read this question, but I had counter questions for this gentleman because I'm not aware what is the time frame he gave his investments to grow. So provided I have the time frame, I could have figured out whether the loss is in the form of the capital or in the return. So that this is one. Second is that, again, one needs to understand and differentiate between or balance between the parameters, which is risk, return, liquidity, and time. People expect equities to deliver highest returns in the shortest span of time, but what happens is reverse. It delivers the highest returns in the longest span of time, or sometimes lowest also. So the time frame has to be little broadened for equities to give you a return of 10 plus or 15% plus CAGR, as we have seen in the data I shared. So for this gentleman, timing is very important. So I need to know the time frame. He should invest.
Okay. Thank you. Jason, would you like to add something? You were saying something.
Dipin has covered is correct. I guess the question which I was reading, that he has been investing in penny stocks. Maybe at times we see the price of the stock and really not get interested. So again, I think Dipin has rightly answered that we have to be more careful about the stocks and the time and the tenure that we are in. Thank you.
Right. So our next question is it good to invest in direct equity or through equity mutual fund? I'm 35 years old. Me and my wife are into IT with annual income of over 25 lakhs. We have no assets, stay in rented accommodation as of now. Yeah.
Shall I answer or you will answer?
Dipinji, would you like to take this?
So I think he needs to do an analysis of the 50-30-20 budget rule first of all. So equity or mutual fund investment would come later. This is one. And if he needs to differentiate between stocks and mutual funds, again he need to analyze his risk quotient, which only he can analyze. So because equity mutual funds are something which comes with the low, moderate to high risk, and stocks is something which definitely comes with high risk. So what I would suggest him is a 70-30 split between equity mutual funds and direct equity stocks. Considering his age, he still has 15-20 years to invest and take a desirable amount of risk in direct equities as well and MFs as well. This is the split I would suggest. And growth stocks, big companies, not the penny stocks.
Thank you, Dipin.
Yeah, and I would add that first of all, definitely add some term insurance, good mediclaims, get into PPF, and have something which is very, very basic model for investment. So that's very important.
Yeah, and one thing what he specifically mentioned is we have no assets. We stay in a rented out as of now. Any advice on that part, sir?
No, he is very young, so rented house is fine. But yes, eventually, by the time you're 40 around, you should have your own house, whichever place you get settled into.
I believe having an own house is one of the most secured asset one can have.
Is it not risky to invest in startups? What is the guarantee of return of invested amount? So it's related to startups.
You are taking, sir?
Dipin, you can take this.
So I see startups is something which carries the highest degree of risk. If I define the type of risk a startup has, it is more to do with the capital risk. Because as sir mentioned about the data that 70% of the startup are not making any returns, any profits. Forget about the ROI on your investment. So if you are willing to take the capital risk, maybe 10% of your capital should go to this particular asset class, not more than that. Because anybody who is willing to take the capital risk, one should explore this startup investments. Otherwise, he should explore other kind of investments, I would say.
So next is related. How can we mitigate this risk? As you mentioned, it's a highest risk investment. It could be a highest risk investment.
Yeah. So risk mitigation can be done in three forms. One is to know more about the management and the people behind the company. If they are visionary, if they are solving a problem, this is one area. Second area is he needs to understand and do his own research in the industry, whether the product or services they have launched a startup has demand for the same or not. Third is he needs to analyze the financial numbers and see if the company is making profits because these startups are into cash burns. A lot of these startups spend money to increase the top line, but there are no profits. And we have studied in finance that price is a slave of earning. So whatever price we are willing to give in the investment has to follow the earning. So these three checklist or check areas he can spend time upon. Post he is convinced with this checklist and the outcome of this checklist, he would mitigate the risk.
And he must also, I think we have given references to few very high recognized platforms wherein a lot of information is available. Yeah. So before getting into the startup investment, the research and other parts he could consider through those platforms.
I'm sorry, there was a network glitch. So I'll come to the next question. What are the investment options for my parents? Both are 60 years plus and funds are lying in FDRs.
I think as in our presentation we mentioned that FDRs definitely at this age, they are pretty good. But then there are senior citizen bonds as well, which are available and returning almost 7.5% return. Then they could also get into the Pradhan Mantri BVS Yojana, which is insurance cum returns. The maturity is, of course, number one, the applicability is to persons above 60 years. And the returns are almost to the extent of 7.5%. So I think they can lead a very comfortable, almost inflation netted kind of life post-retirement. Could consider these options.
So the next is, are government bonds fully secured for investment? That's a question from my side as well.
yeah, definitely. In India, there have, except for a couple of state related bonds, couple of state, I would not name the states, but generally, yes. If it's a central government RBI related, they are definitely secured.
So once you invest in government bonds, you can get to know whether it has a sovereign backing or not.
Yeah.
So the bonds which has a sovereign backing are 100% secure.
Yeah, absolutely.
The state one doesn't have the sovereign backing.
Yeah.
So there are some more questions, but in the interest of time, I would like to conclude this session. So we owe a special vote of thanks to Jay sir and Mr. Dipin for being here and giving us your expert insights on this topic. I would also like to thank Bhavya Tejwani and Aryaman for making their efforts to make this webinar to happen. Thank you so much, all the participants, for sending their questions, for attending the webinar. If you have anything, you can let us know, connect with us. Thank you so much. Thank you.
Thank you.
Thank you.